All right, we're live streaming now.
Perfect. Well, look, kia ora and good morning, everyone. Fantastic to be with you on this slightly wet, miserable summer day. At least that's what I'm told it's supposed to be at this point. What I want to do for you this morning is take you through quite a lot of information. I can always do more, but sometimes I worry that if I do less, then I have to spend sort of more time with questions that I don't have a nice chart for. So I've got quite a bit. With the leave of the chair, I'll wait till afterwards for questions, if that's all right, only because there is a bit of a method to the madness of the presentation, and then we'll sort of get into things after that. Both a bit of a general economic update. There's some elements of the national economy, there's a lot of local stuff, but there's also a lot of local structural stuff around what's going to have an influence not only on the district but also on yourselves as governors at a council level, notwithstanding all the changes that keep coming out on the local government front. So with that, we're currently searching for the new economic normal, and I say that because we are still trying to figure out what's the right Goldilocks zone for the economy. It's clearly not 2019 anymore, that's still the most usual baseline, but business conditions, business cost structures, council cost structures have all fundamentally changed compared to then. 2020 is a bad comparison as well. I don't want lockdown to ever be a comparison to what normal should be. 21-22, as the economy was starting to recover and then sort of got so hot that yes, the economy was in a great spot, but you couldn't find any resources to do stuff with, or builders or anything else. Still a pretty rubbish comparator. 23-24, when inflation got really hot and we then had to curb the economy to try and bring down inflation, has not been a fun experience either. So we're still trying to figure out what should we be aiming for? What is fast enough to keep economic momentum going, but sort of not so fast that you start to burn out the ship either. And I think that's one of the challenges and difficulties for the moment. We've currently seen the Reserve Bank cut the official cash rate back to 2.25%. Reduces borrowing costs, means that it's less worthwhile to put your money into savings, means your mortgages start to come down and people can hopefully spend a little bit more. Now, I'm no doctor, but I understand that once you add a defibrillator to someone's chest, you don't hold it there for the next 5 years. At some point, when you jolt the economy back into a bit of activity, you have to remove that stimulus. And you can see on our forecasts, and it started to come through from the Reserve Bank as well, that they are now deliberately trying to stimulate the economy. You got told a couple of years back to cool the jets. This time round it's open the jets back up, please. But once that momentum gets going, the Reserve Bank will need to move the official cash rate back to around 3%, which is what everyone estimates is roughly around neutral. At that point, they're adding nothing specific to the economy, but they're not taking away anything either. There is a little bit of worry in our minds that at the moment we've got a higher unemployment rate, we've got weaker economic activity, which should be leading to much less inflation, yet we've just had inflation that's hit the top of the target band at 3%. So we're a little bit cautious that given how long interest rates take to affect the economy, in a year's time, when the interest rate cuts that have been made the last 2 months fully start to hit, the green shoots that we've been talking about might well have grown into a patch of grass, and we might well be watering it far, far too quickly. You then start to have a bit more inflation, and the Reserve Bank might have to then curb economic activity even more. You'll see on the chart that's our upside risk. It's not the current central view, but it's a worry that we hold in our minds. It seems quite hard to suggest that you'd have the economy going at such a sort of gangbusters pace that inflation would be rocketing up. But again, we find ourselves already in a pretty constrained economic time and inflationary pressures are still there. So we're just cautious after the last couple of years. At the moment, households are cautious as well, but sort of they've had quite a variety of how they expect things to play out. For the last sort of 2 years or so, households in general have said that life at the moment sucks, which has been pretty understandable. On the chart behind me, anything below 100 is a net proportion of households that are pessimistic about the future, anything above 100 optimistic. And you can see that sort of current conditions index, what people say is happening to them right here, right now, has been overly bad and continued to be so. But the second half of last year and first half of this year, households were going, yes, it sucks right now, but I can see better things in the future. I expect that in a year's time I'm in a better economic place. My mortgage rate's down, I'm still feeling able to spend a bit more and things start to pick up. Through the second half of this year, that optimism about the future has fallen away, and you can sort of see that in the chart where it's now become net negative. And I think that's because you've seen people that have gone, yep, my mortgage rate is coming down, and so that was helping me think better about the future, but now it's really hard to find a job, and I'm worried that even if I've got a job, I might lose it. And if that's the case, I'm going to sort of act unemployed, and I don't think that the future's all that bright anymore. As an economist, I'm a lot more optimistic that actually there is a turnaround coming through, but you can see that households have been really restrained. You've of course seen as well cost of living pressures continue to hit, and I'll talk about some of those as we go through, but suffice to say headline inflation might not be as hardcore as a couple of years ago at 3% instead of 7.3%, but it's the essential costs that are still hitting households, food and energy and similar, that are a concern. So, let's talk about the local economy. Like I say, I want to give you some sort of structural pieces because there's, of course, quite a lot happening in your local neck of the woods. First and foremost is just a bit of an idea of what the structural makeup is for Masterton. You can see that here, looking at sort of the contribution to GDP by each industry, in orange for Masterton and blue for provincial economies on average across the country. And I've done that because there is, I think, a real challenge sometimes of comparing an area like here to the national average. When the national average is a third made up by Auckland, probably not the easiest comparator that we can make. And so at Infometrics we've sort of come up with our groupings based on the LGNZ definitions around the likes of the metro, provincial and rural areas, so we can slice and dice things and make those comparisons. You can see the largest part of the local economy is the health sector, and that's given that you are sort of the larger population base. You've got sort of a lot more healthcare provision and also social assistance that's coming through here in the district, larger than the provincial average. The challenge with the provincial average is it really depends on exactly where you are as to or who you're located near to. So a lot of provincial centres might well be near what we might define as a metro, and so can use their health resources a whole lot more. For you guys, going over the hill or up to Palmy is still quite a bit more of a trek than other provincial centres, so you've got more of that health base here locally. You've also got quite a large amount of professional, scientific and technical services, so that's, accountants, it's lawyers, it's economists and a whole lot of others, and I think that's highlighting that there's still, or has been certainly the last couple of years, a big work from home shift as well that's meant that you've had a few more people that are often living and working here but often might be contracting for other organisations across the country more virtually. And then you've got both agriculture and the likes of the manufacturing industries in there as well. Most of your manufacturing, not all, but a fair amount of it in the local district, of course, is food-based manufacturing. So that's probably the most expected bit, that you do have a bit more of a primary sector bent than the sort of national average, that's true. And you can see there's a lot more, there's less manufacturing and primary sector relative to other provincial centres, which is because you've got that bigger base when it comes to the likes of health and otherwise. But just gives you an idea that, in a sense, yes, you will be influenced heavily by the primary sector, that's true. Those areas are still some of your bigger contributors, but you've got a little bit more, I guess, stability coming through from the likes of health and professional services. As always, there's it depends in there as to how things play out. Professional services, which has been one of the biggest growing industries in New Zealand for about the last sort of 10-15 years, has taken a real sort of pullback the last couple of years, particularly in the lower North Island in general, around Wellington, based on the pullback in government spending. In fact, we've actually seen that in Wellington City, just as a bit of a sort of local example, that the drop in jobs has been much more heavily felt in the private sector that contracted to government than direct government itself. That sort of contractor spend piece has been a whole lot harsher, and so that will have influenced the local economy. What's interesting is if we then look at how GDP has shifted over the last 20 years, so almost all of your industries will have actually increased in absolute terms, but it's interesting to see sort of the relative shift and how similar or not that might be relative to the sort of provincial average. And what's interesting, having done quite a lot of these presentations across the country, is that Masterton in general has followed a fairly similar, not fully the same, but similar script to what you've seen in the provincial economy average. You sort of haven't seen any outsized shifts it's towards any industries or away from any industries, which means that you are sort of, I guess, following trends a little bit more closely. On that basis, you can see the likes of health, professional services and construction have been the largest relative increases, and again, certainly on the likes of professional services, that has also helped grow incomes over time in the local area, because those are areas, industries rather, that have higher pay in general. The areas that you've pulled back on are the likes of manufacturing, the professional services, the manufacturing, the primary sector, and the likes of rental, real estate, and all of those sort of areas. All of those are actually still larger than what they were 20 years ago in terms of GDP value add. They're just not quite as important as they once were. So again, I guess the way to read this is that you haven't seen too much of a Masterton charting a distinctly different path to many other provincial economies. You've sort of seen a bit more of a shift over time, as you've seen in most provincial economies, but also you are less reliant and therefore less exposed to the ups and the downs of the primary sector. And to be honest, given a further 4% or so fall in the global dairy trade numbers this morning, I think that helps just provide a little bit more context around the sort of vulnerability of how quickly your economy can move. Sometimes we are seeing that provincial economies aren't moving as fast as everyone might expect. We've seen a higher dairy payout and higher meat numbers, and everyone thinks that there should be sort of money falling from the sky. Instead, you're just seeing a bit more stability, because those rural sort of provincial economies that have less of a sort of direct primary sector focus, like you're seeing here, don't have quite as much of a quick response to some of those economic trends. Population-wise, after a fairly flat period up until around 2008 or so, there's been a fairly continued climb in population coming through locally. It has slowed down a touch since the pandemic has come through. You can, if you sort of look at the gradient, things from about 2013 to around sort of 2019 or so were a pitch faster, and then it's just slowed back, still increasing, but at an ever so slightly slower pace in recent times around that. That's, I think, a factor of an increase in competition that we're seeing across the country in terms of people moving around, sometimes leaving areas, sometimes coming in. You've seen a big shift as well in terms of working from home trends and remote working, and that's started to influence how New Zealanders have been living. Auckland, for the first time in about 200 years, had a population decline during the pandemic because they didn't have as many people coming in from overseas, which they normally did, but instead they had a normal number of people moving out to other parts of the country. So there's still a focus around the likes of housing affordability, there's a big focus around livability and lifestyle, and around job opportunities as well. If you sort of have that trifecta, you start to see sort of continued levels of growth, and so part of that is showing through here. It's interesting to sort of note, again, sort of generally how similar Masterton's been compared to a number of the other comparators when you sort of look at population growth over time. A little bit different from the national average in the last wee while, and you can sort of see there that both Masterton and the provincial average in general has been sort of less volatile than the national figures in terms of both the pitch down when we close borders, the pitch back up when we reopen them, and then the pitch slower this year. In fact, you guys have sort of been a little bit more through the middle in recent times through both those ups and downs, and so again, from a planning perspective, it gives you a little bit more confidence is potentially overdoing it, given it's very, very hard to judge what population should do. I mean, if you look at that, you sort of go, well, which of the time periods is sort of the best one to pick? And we can certainly get into that, because I know there's been some questions that have come through. But you can start to see on this figure that there has been fairly consistent levels of solid population growth continuing, slightly faster periods at some points, slightly slower at others, but sort of pretty consistent over time. And what's driving that has for a period been much more heavily been internal migration, so more people from other parts of New Zealand moving to Masterton compared to people from Masterton moving to other parts of New Zealand. Again, a large part of that was around lifestyle opportunities, as well as house prices and sort of job opportunities and the likes. You'll see in recent times that figure has pulled back a fair bit. It's still positive, you're still seeing people that are moving to the area from other parts of New Zealand, but it's not quite to the same pace. And in my mind, that's not because people aren't wanting to move around as much, it's much more because competition has heated up substantially. You're seeing a lot of other areas and parts of the country, certainly since the pandemic, that have been trying to attract talent from across the country. Hawke's Bay's been doing quite a lot given their sort of sunshine hours. You've seen Nelson and Marlborough and similar doing the same. The biggest winners so far in recent times has been a bit of a southward shift. You've seen the likes of Rolleston and Selwyn district, Rangiora around Waimakiriri district outside of Christchurch that have been seeing quite a lot of inward movements. The same with parts around Queenstown and Tekapo and similar. And that has been because people can work a lot more from wherever they want to as long as they've got a good internet connection, and increasingly if you've got Starlink then you've sort of got options there. So there is a real focus in that element. In terms of the working from home piece, just briefly, we know that about a third of the New Zealand workforce works at some point during the week at home. It's sort of changing around what days it is, but you can sort of see a fairly consistent pattern there. So there is a much wider opportunity for people to do that. We estimate at the moment that up to about 41% of the New Zealand workforce can work from home at any given time. Before the pandemic, it was more around 29%. So you have seen quite a big shift in just the proportion of people who are now available for that more remote working. The challenge, I think, when we look through some of these figures, sorry, I'll just go back briefly. The other 2 points I wanted to make that I forgot to was the international migration piece, the green line there, in terms of, you will have heard about the high level of New Zealanders leaving the country, which is true, but we're still actually seeing more people come into New Zealand than are leaving. We just don't focus on that second figure quite as much. But you can see locally in more recent times, certainly around the pandemic, there has been a bit more international population growth that's been coming through to Masterton compared to other sort of previous times. And I think that sort of highlights that again over time you are seeing we're going to be more reliant as a district on migration to keep the population moving. That orange line down the bottom that's sort of flat and sort of hovering on either side of the zero line is your natural increase, the number of births happening locally minus the number of deaths. And over time with an older population, and we sort of continue to see this across New Zealand, you're going to see areas that are going to have more people that pass away than are born every year. That means that talking about growth, it becomes a little bit more challenging because it's all going to be focused a lot more around the sort of migration piece. But given the sort of strong level of previous internal migration that you've seen coming through, and the fact that you've still got this really big push on lifestyle, I expect that to continue into the future, coupled with the likes of housing affordability outcomes and the thinking around job opportunities in the future. Yes, short term is tough, but we still expect that sort of long-term resumption in activity and jobs. You can see the variety coming through across the country in terms of population growth over the last year, and like I said, a bit more of that sort of southward flow. Selwyn sort of rocketing up 2.4% or so the last year, but other parts of the South Island in sort of stronger regards. You can see that parts of the lower North Island though are a whole lot more patchy, and part of that driven by the likes of employment changes, and you can see some of that around the likes of Ruapehu district and similar, lost a couple of mills, not quite as easy to retain their workforce, and a little bit more variety throughout as well. Let's talk a little bit about some of the other economic indicators we're seeing recently. In terms of local consents, you've seen those numbers that have come back quite away from their peak. In the last year, they've picked up ever so slightly from that more recent low point. I guess the challenge here is if you look at that chart, yes, there was a big build-up from about 2017 onwards, but again, trying to establish what the new normal will be for the local construction sector is a bit of a challenge. It's probably not what it was sort of through after the GFC until 2016, which was sort of a lower pace, but equally there was a bit of a Mount Everest moment the last couple of years, which has seen a whole lot more work than normal that has come through. And so we expect again things to average out a little bit more in the middle between those two into the future as that sort of normalcy starts to regain a bit more momentum. The slight pickup you've seen in recent times is consistent with what we're seeing in a number of other construction markets across the country. It's not a huge boost, but it's a little bit more of a pickup as people have started to figure out where they're best to start to build, and also when they consider the likes of infrastructure, provision and similar, which in some parts of the country, don't get me wrong, noting that infrastructure is expensive and difficult to put in, but some places just haven't got any capacity whatsoever, and so people are having to sort of look around for those opportunities. At the same time, you've seen a lot more investment coming through on the sort of non-residential side, so commercial and industrial works that are emerging through, and also some of the work that's happening from civic buildings at the moment, which is part of that boost up and the 60% increase that you've seen in recent times in terms of non-residential consents. But I think, again, in terms of the residential market having pulled back, the non-residential market's in a better place, so there's still work out there in the construction market, and there always seems to be a bit of infrastructure that needs to go on as well, not only from local government but also in that transport space too. There was a question around tourism activity, and so I wanted to put a chart together specifically for that, and you can see I've charted GDP. You could also do employment. They sort of don't show too much of a different trend. In Masterton, around $60 million a year worth of GDP is coming directly from the tourism sector, and around $100 million worth of spending happens from the tourism sector. Now, the difference in those two figures is that you've got to buy, or your local tourism providers at least, have to buy a lot of their services from out of the district as well. So not all of your spend remains here. For example, any fuel that is bought in the district, yes, it goes to the fuel companies. They had to buy that fuel from not New Zealand, and so that some of that money, some of that value has to sort of literally be trucked out or trucked in at other points. You can see the sort of recovery that had been coming through at the national economy level. The fact is you've seen a little bit more growth in other parts of your economy in recent times, which means that the sort of proportion of economic activity in Masterton coming from tourism hasn't been as much of a rebound, or hasn't seen as much of a rebound. The actual level has recovered over time, so that the amount of economic activity, but it's sort of not as large of a proportion as it sort of previously was. You can see it's sort of more in that sort of equivalent where it was sort of before the GFC. Like I say, that's not saying the tourism economy isn't large, it's still adding a lot of value. It's just that you've seen other parts of the local economy that have grown even faster in recent times to sort of bring that forward. The reason as well that I keep referring to the tourism sector rather than any one industry is because, of course, tourism is made up a whole bunch of different proportions of each industry. A cafe, for example, in town is going to be a tourist entity when I go and spend in it, because I'm not from here locally, but when you guys go and spend on it, well, you're not tourists, so you sort of can't count cafes or restaurants or accommodation as fully tourist or not. The other point I'd make is that you and I often think of tourists as the people who wear fanny packs and take around their money and go and do fun activities. Yes, true, but your tourists locally will also include contractors and similar from out of the region that stay here for a period of time. So just sort of noting a few differences in those figures. The last couple of bits before I turn to another section, just briefly looking at the housing market. And what we've seen there in recent times is that house values, that is 3.2%, not 3.2%, because clearly I can't read when putting my own slides together. But house values are down about 3.2% compared to where they were a year ago, and sitting just over 20% below the peak. If you look really closely at the chart in recent times, it is bending down for Masterton ever so slightly, but in broad terms, at both a national level and locally, your house values are sort of just moving sideways. And I think a big part of that is because you have seen, generally speaking, high levels of supply into the market. A number of listings have grown quite considerably, so there's a lot of potential homes there, and at the moment there's no real reason for anyone to want to go and buy a house for a price over and above their expectations. If they do want to buy a house, they'll go and find the 5 or 10 places probably on the same street that are for sale and go around until someone gives them the cheapest price. And if you want your house to be sold, you have to make sure that you're sort of cutting your price to give the best offer. So a lot of additional supply in terms of existing homes. I showed you the high levels of building consents the last couple of years before the pullback. That's a whole lot of new homes that have also entered the market, and of course people are more constrained in their own finances, people are worried about their jobs, and so the number of buyers out there isn't astronomical, and still means that people who are buying have a bit more control over the market than people who might be wanting to sell. One other area that I wanted to highlight, because I know that there were some questions around the likes of household income and similar, and I have included some of those specifically, but I just wanted to highlight some of the other analysis that we've done at Infometrics over the last couple of years in terms of wellbeing outcomes. Now, wellbeing sometimes seems to be a dirty word in local government. It goes from being flavour of the month to not, depending on sort of the term of government that we're in. But wellbeing outcomes are important. Now, you can call them wellbeing, you can call them standards of living, you can call them a whole lot of things, but effectively what we wanted to do at Infometrics is take a little bit more of a wider view of economic trends. We often look at GDP and employment, and they do tell us a lot, but there are other elements that we wanted to include there, which is why we've created our regional wellbeing framework. You can see this is just the top piece. All of the data sits underneath this, and most of it is publicly available, certainly for Masterton. But just sort of noting the concept that I'd hate to try and condense this figure down into one figure like GDP, because I might well tell you that your well-being is good, and that might mean that your health is good and your social connections are good, but your environment is bad. Does that still represent a good wellbeing score? Probably not. There are sort of nuances. You can see though that Masterton's figures are broadly sort of fairly reasonable across all of the different domains. The way to read this chart is anything that's close to the 0 point in the middle is generally the worst wellbeing score relative to all the other territorial authorities in the country. Anything that's sitting out at 100 on the outer edge of the rings is the best wellbeing score. And I've given you both the national average and also, like I said before, the provincial average. And that's because if I included Auckland on here, Auckland looks almost exactly perfectly like the national average as well, given how much influence it has on figures. And so you can see there that there's generally speaking a fairly healthy level of sort of wellbeing outcomes that are coming through. In many areas you're either slightly above or very slightly below the provincial average, but there's sort of nothing that's sort of too far out there. A little bit lower on the likes of income and consumption, and we'll sort of highlight, I'll get into that shortly, but in general some sort of pretty solid outcomes. This covers anything from the likes of drinking water quality and life expectancy, voter turnout in general and local elections, the truancy rates and so on. So quite a comprehensive set there as well. Which takes me to the income and the affordability bit, because that's still fairly vital, not only in general for the economy, but of course for yourselves as decision makers thinking about sort of policies that you have to work with and what the community can afford, but also what they need in a sense. There's a variety of metrics that I've pulled together for you, again with the various comparators, looking through the housing piece to start with. What we know is that although there's a lot of ways that you can define affordability in terms of disposable income or anything else, in New Zealand the biggest influences on affordability are always your housing costs. People can make fluctuations in terms of what they buy at the supermarket and similar to fit the budget. They can do the same to a degree with energy and a lot of other costs, but housing is fairly vital and pretty sort of inelastic, harder to sort of shift around. And you can see on this chart that there's been an increase over time nationally, provincially and locally in terms of the challenges of rental affordability. People are spending a higher proportion of their income here locally and across the country on rents over time. You can see in recent times, since about 2021, there has been a bit more of a boost up in rents coming through. That seems to be a combination of continued population growth that has been emerging, but also not quite as many additional rentals that have been coming to market, or not quite as much turnover that's been showing through. And so again, the supply and demand elements means that you've got healthy levels of demand, maybe not quite the same level of rental supply, and also, of course, the rental supply that is available, there's been a whole lot of focus on higher quality in recent times. Now personally, as a renter in Wellington, I like higher quality houses. I like to be warm in the place that I live in. I like to not live in a mouldy place. But over time, those increasing costs, where you don't have as much additional available supply that comes to market, has been putting a bit more pressure on prices. I'd still argue in a sense that I'd be happy to pay a higher price for a better quality house. The challenge would be if you were paying a higher price and still getting a pretty poor quality house. But again, you can sort of see that trend over time. Again, provincial areas have seen a continued increase in that unaffordability of rentals as well. In more recent times, you have had a little bit more of that additional supply of housing that's come online for Masterton, which has pulled things back slightly. Not back to where it was, but you're starting to see things at least move in a better direction in terms of advertised rents and what's available out there. In terms of housing affordability, you've also seen an improvement there. Now, there's two broad ways that we measure housing affordability. I've got both of them with this in the next slide. The first one is to just give you a sort of a conceptual idea of how many incomes might you need to save up to buy a house. Now, of course, people don't save up 6 or 7 years worth of their income, spend nothing else and then buy a house with it, but it gives you a bit of an idea of roughly how large are we talking in terms of the cost of buying a dwelling. And you can see that over time, Masterton has remained more affordable relative to the incomes that are here locally than what you might have have to spend if you were in other parts of the country, either at the national average, which of course includes all the metros, but also even the provincial average. Masterton remains more affordable on that basis. Everything pitched up when house prices skyrocketed towards the start of the pandemic. That's what low interest rates and sort of a pretty unconstrained economy will do to you in the short term. And then you can see in more recent times that affordability has actually improved back to where it was before the pandemic on an average house values basis. So that does sort of highlight that not only have you seen an improvement in relative affordability compared to those peak years, but over time Masterton still remains a more relatively affordable area to buy a house than most other parts of the country, which is why you've seen that continued focus on people moving here because of not only the lifestyle and the jobs, but also because of that relative housing affordability. The same is true when we look at the likes of mortgage affordability. So how much of your income might you need to spend in any particular area to service a mortgage? And we've got a bunch of assumptions here. We take the 2-year fixed mortgage rate, we have it over 20 years, and we take a 20% deposit. You can argue any of those various variables, it won't change the relative differences here, which is that, again, still repaying a mortgage here in Masterton relative to average incomes here in the local area is more affordable than many other parts of the country. And you can see that, again, in recent times with the falls in mortgage rates, you're starting to get a even more affordable ability over time. Not back to where it was sort of pre-pandemic yet. Interest rates are still higher, and again, house prices haven't necessarily fallen back as considerably, but over time you are seeing incomes that are slowly but surely rising. I guess the interesting piece here is that although you've got better affordability on the housing front, you do still have that challenge around renting, and one of the difficulties that starts to often make is that the third part that is a lot harder to measure in terms of affordability is how much or how quickly people can pull together a deposit. Yes, you might be able to afford the mortgage, but if you can't get the sort of 20% together, then it becomes a whole lot more difficult. And with those rental increases and increasing unaffordability on the rent side over time, it means that you are, if you're a renter like me, you're putting more money into the rent, you're not able to put as much into the savings account, and it then takes you a bit longer to make the mortgage deposit, which sort of pushes the entire thing out. So we know that housing's still in a tough spot across the country, but again, relatively speaking here, you guys do have a much better opportunity on the whole than other parts of the country too. And then to reinforce that, just finally, around the likes of where incomes sit in the local area, you can see Masterton there. I've given you the other weighted upper areas. I've given you the provincial average, the national average, and Tararua as well as sort of a nearby comparator. At the moment, about 115k is average household income. And so that's sort of based on a whole bunch of variables that we have for the local area, the number of people that are working and what they get paid, number of beneficiaries and superannuitants and everything else. But it gives you sort of a bit of a relative sense of where things sit. That's slightly lower than not only other parts of the wider upper area, but also of the provincial average. Not by a huge margin, but is again just a little bit different there, a little bit lower than otherwise. You still have seen income growth over time. If you actually look at income growth for not only Masterton but also the wider upper, all of the figures have generally been keeping the same pace over time. It's just that you've got a slightly lower starting point, and unless you have outsized larger increases in your average household income, there still persists a little bit of a household income gap. Of course, there's a lot of varieties down here in terms of the different incomes that people might have, the different situations, whether or not they've got kids or not, if they've got other dependents. So there's a lot of scenarios that could be in here, but this at least gives you a bit of an average feel for where things sit on the mortgage, on the household income front. Very briefly, I wanted to touch on a few other economic indicators we've seen in the short term. I've given you a lot of the structural pieces, but of course there's been a lot that's been happening more recently as well. At the moment, sort of similar to the population growth that I showed you, we've seen jobs growth that has been more concentrated around the South Island compared to the North. Part of that, a large part of that, seems to be around the likes of tourism. Stronger international tourism growth coming through in the South Island. There's just been a lot more opportunity that's been coming through, a lot more spare capacity, and so you look at that in terms of the likes of international tourists coming back into Queenstown Airport for skiing and similar. Number of international arrivals into Queenstown Airport have averaged about 140% of pre-pandemic levels. Number of international arrivals into Auckland, Wellington and Christchurch, 85. So quite a difference there. And at the same time, you've seen lower domestic travel across the country, particularly being felt in the North Island because you've got the two big population centres of Auckland and Wellington, and you're seeing that particularly in the lower North Island as well, because Wellington definitely hasn't had as much money to spend with the sort of job cutbacks and similar in the public service, and so therefore that domestic travel piece hasn't been as upbeat. You've also seen a bit more pressure on the primary sector as well. Yes, there's still been some good returns, but of course there were some pretty dry conditions last summer for large parts of the lower North Island, and that meant that there was quite a lot of additional costs being put on the primary sector, which left less money being put out into other areas too. Local figures for the Masterton district show a 2% drop in employment of people who are living in the district and who are working, and so that's sort of been a continued pullback over time, and again sort of highlighted the challenges that you're seeing locally and the concerns that households often have on the employment front. A very big difference though depending on exactly what industry you're in, and I think that's probably a key challenge at the moment, is that the economic downturn that we've had and the economic recovery is quite bitsy. There's sort of not a broad-based increase or improvement across all industries. It's a whole lot more spread out. You can see the biggest declines in recent times have been about 150 fewer jobs in manufacturing compared to a year ago. I think that's pretty well understood in the local area, so I won't go into that in too much more detail. That construction pullback, particularly in the residential space, has seen a lower number of people in the construction sector and less as well in the likes of public administration and in the likes of retail and the likes. Top of the picks, a little bit more financial service employment starting to come through. Still not massive, but clearly showing a little bit more work going on, and a little bit more in the likes of accommodation and food services and the primary sector too. Pretty small and limited, and I guess what's interesting is that most other parts of the country that we look at, the two biggest contributors to jobs activity at the moment has normally been health and education, and so the fact that you're not seeing quite as much of that, even though health is your biggest industry, does highlight that you're not sort of being driven as a local economy as much by the usual trends that you're seeing in other parts of New Zealand at the moment. And I think partly that's probably because of the challenge of finding the health workforce outside of the major centres as well. Spending levels, probably one of the better economic indicators that we have, just because it's fairly current and it gives you a pretty good view on things. If people are spending money, clearly things are all right. They've got the cash to spend. If they're not spending money, either their mortgage has gone up, they don't have a job and therefore can't spend money, or they're worried about their job and so they've got money but they're acting like they're unemployed and keeping their money a bit closer to their chest. You can see in recent times things have been a little bit more limited. Spending levels have broadly plateaued in the Masterton district at around that $500 million a year mark. If you look really closely at the chart, and you would have to get a magnifying glass, there is a 0.3% increase in spending locally over the last 12 months compared to what there was before. It's still pretty slim pickings, but it's just some of those first signs of economic momentum starting to pick up a touch. Also, I think impressive to see a slight increase in annual spending levels locally, even when you've seen a 2% drop in employment, and it still shows that part of that is going to be people paying higher costs for groceries and similar, but there's also an element where people are clearly still trying to find a bit more momentum in different areas. The difficulty for a lot of retailers is that it depends on exactly what you're selling. Now, if you're selling durable items, big things that you don't need to buy as often and you can put off the purchases, they're generally finding it quite tough. You don't need to buy new shoes or new clothes, you don't need to go and buy a new whiteware or a new lounge suite or similar all that often. In fact, at the moment you're putting that off. The likes of food and similar though is pretty vital, and so you're still seeing that a number of those operators are doing all right at the same time as seeing higher input costs themselves as well.
Sorry, Brad, is that for online purchases and local purchases?
So these figures are more in person through sort of payment service machines, so anytime you tap a card, it doesn't include cash, but we're not too worried about that given cash usage is not huge, and because I generally expect that the likes of cash usage will trend with how cards are being used. It doesn't include the online spend bit, only because one of the challenges with the online spend that we've found is that often that gets routed through distribution hubs and similar, so it doesn't give a great approximation for local spend. But I think probably, notwithstanding the fact that it doesn't include the online piece, it still gives you a pretty good idea, I'd expect, over sort of spending appetites in a local area. On to the last sort of two parts I wanted to highlight is the primary sector, given it is still important and is obviously fluctuating a lot at the moment, and also some... Oh, sorry? Still, like I said earlier, it's not as vital as I think some people make it out to be, and I mean that with no disservice. It's more that if you did or were seeing that some people seem to make the point that their economy is 40% primary sector, I'd get really worried at that point, because it means that any time you get a bad season, you crater the entire damn thing all at once, and so it's sort of better to have a bit more variety. But it's moving about and quite a lot. I've also got some local government costs that I'll cover too. First and foremost, you are seeing much better prices on the meat front coming through. The likes of lamb prices have hit above $11 a kilo now, which is impressive, and you're seeing those trends coming through. A large part of that is because demand for protein is still quite high, not only here in New Zealand but also around the world, but supply is quite a bit more limited. New Zealand supplies something like 10%, I think, of all of the beef that goes into McDonald's hamburgers in the US. And the fact is they've got not enough cows to sort of supply themselves. US beef stock levels are at their lowest in something like 50 years. And they're now worried about screwworm coming over the border from Mexico. So New Zealand's meat position is quite solid at the moment in terms of prices and what we're seeing received in. The difficulty a little bit is that supply piece is also starting to hit a little bit more locally as well. A little bit hard to see on the chart here, but lamb and beef volumes across the country in terms of killed volumes are actually down 4% from where they were a year ago. So you are getting higher prices, but there's not quite as much meat out there as before. And so there's just a little bit of caution over looking at really, really high prices and going, oh, that's clearly flooding a lot into the economy. High prices multiplied by a lower quantity still means that there's not as much of that sort of additional cream or fat, maybe, being added to the economy, if you want to use that analogy. But you are still seeing quite a bit coming through. There's questions around feed levels and everything else. Did that limit expectations last year? Potentially to a degree, but you can sort of see that things are a little bit more flattish. They've started to turn the corner a little bit more on the lamb front in the last couple of months, but still down on where things were a year ago. At the moment, looking at commodity prices in general, I don't want to explain the chart in too much detail because there's a fair amount we've done here. The challenge at the moment is that although primary sector returns are high, primary sector cost pressures have been high as well the last couple of years, so I don't just want to show you the revenue number and ignore the costs. So effectively the numbers here are commodity prices for New Zealand commodities relative to inflation adjusted returns over the last decade. Basically anything above 100 here means that you're making more profit, anything below 100 means you're making less money than before. And you can see the real differences there in terms of horticulture, meat and dairy all making quite a bit more money than before. Dairy and horticulture pulling back a bit more in recent times as supply and demand have shifted around. Forestry remains pretty atrocious, to be blunt. Demand is just not there to the same degree across the country, across the world. We've seen that there has been a little bit more exporting activity in recent times, but the prices being received for that is pretty limited. And again, a real challenge in some areas where New Zealand's major export partner, China, takes about 50% of all New Zealand's wood products. At the moment, they don't need a whole lot more houses. They've had 3 years now of population decline for the first time since the famine in the 60s. They've got a whole lot of spare houses and house prices that continue to fall. They just simply don't need the wood to the same degree. It's a bit more activity coming out of the likes of the US and Vietnam for New Zealand wood products, but again, prices are a whole lot more limited. So let's talk about cost pressures to sort of bring it back a lot more to local government. I've given you some of the structural pieces for the local economy, but of course sort of turning minds to a little bit more of some of the operations and some of the tough decisions that not only will you have to make as decision makers, but also some of the challenges that your ratepayers and residents are going to have to toss up in terms of what gets provided. Is some of those challenges. So as I said earlier, headline inflation has re-accelerated up to 3% over the September 2025 year. What's I guess different compared to when you saw inflation that spiked to 7.3% is that there's a lot of more volatile prices in there at the moment. It's the fact that butter and olive oil, chocolate, coffee, beef prices, mince and all that has increased quite a lot, quite sharply in recent times. The difference compared to when we saw inflation head to 7.3% though, is that at that point things were very broad-based. It was all the products I've just described, but it was also your 2-minute noodles and everything else. Like, it was a real random stuff that was all just creeping up. And you can see on this chart that what we refer to as core inflation measures, so sort of once you strip out some of those volatile pieces, they are generally moving sideways. There's a little bit of a pitch up in the numbers, but not nearly to the sort of pace that it was previously. That does give us a lot more confidence that headline inflation is not going to be quite as intense as it might have been before, but there's still, again, some uncomfortable cost pressures there. The difficulty is that I can tell you that and scream it from the rooftops until I'm blue in the face, but you and the people who are out there in the local community don't really care about the headline inflation figure, because it includes all of those pieces we talked about earlier in terms of, buying furniture, buying whiteware, buying clothes and similar. You will defer that as a household at the moment because your vital costs, your necessities of life, are continuing to cost you a whole lot more. Food price inflation sitting about 4.7%, which is uncomfortable and a very frequent cost that you see all the time. The worry I have is a lot more around that energy price inflation, where electricity is now double-digit growth for prices over the last year, the fastest since 1989. Of course, that then has an implication not only for households, but also from a council point of view. Some of the services that you have to provide, wastewater and similar, all has to use an amount of electricity as well, and the commercial rates for that have been going up even more. So there's real cost pressure there on some of the absolute must-dos that are putting people under a fair amount of strain. One of the difficulties that we're seeing from a business point of view is that that's also hitting businesses too. Inflation we talk a lot about from a household perspective, but looking at input and output costs, you start to see some of the challenges. Now, I gave you the point before around the likes of forestry returns and how they've been pretty limited, and you can sort of see that on the top part of the chart. Since about 2019, you've seen something like a 3 to 4% increase in what foresters are getting paid for the stuff that they're selling. But you can also see sort of a nearly 22% increase in the cost of doing business for those operators. Their margins have been killed. And I think that's one of the real difficulties you're seeing, particularly in the manufacturing sector at the moment, is that the price that they can receive for the goods and services they're selling hasn't been able to increase by nearly as much as the cost pressures that are being added on, which is why you're seeing a considerable level of consolidation across the national economy. Businesses, particularly in manufacturing, are going, look, I've still got to produce, but I can't afford to have things spread out as much as before. I've really got to try and have the most efficient single operation as I can. Nelson has been a bit of a bellwether of that recently. They've seen about 5 or 6 major closures or announcements in the last sort of 6 months of various entities. None of those businesses are actually closing down shop. They're just closing down the local shop because they're trying to bring all of their operations together to try and limit some of those cost pressures that they're feeling. That's important still for a local economy like Masterton, given some of those pressures and how important sometimes those anchor employers can be. Sometimes your manufacturers are sort of that bigger, bulkier piece, and again, they have a bit more of an influence not only on the direct employment that they have, but if they're not spending as much as a big employer, then the sort of flow and effect to other local providers can be compromised too. Now, all of what I've just told you is all good and well if you were a business or if you're a household. But unfortunately, council, you don't buy a whole lot of nappies or bananas or even forestry and wood all that much. You buy concrete and bitumen and rebar and services, people's time. And so one of the challenges we are seeing at the moment is that it really depends on what inflation figure you look at as to what sort of pressures are coming through. And so some of the work that Infometrics has done has been looking specifically at cost pressures for the local government sector. We did a piece of work in the last year or so for Local Government New Zealand trying to understand that, both looking at both capital and operating cost pressures, and over time we're doing a bit more work for the sector trying to make that a bit more regular reporting. We talk about headline inflation every quarter. We almost never talk about the different components of local government costs. You can see some of them here and how just how much of an increase you started to see at points. End of 2022, the likes of your transport capital costs and similar were increasing at nearly 20% per annum, which is of course quite different from your headline 7.3% annual inflation rate for a household. The likes of increases or pricing pressures have broadly stabilised a bit more over time, but I think there's probably a couple important points if you look at the more recent trends. Almost nothing has become cheaper. So yes, your inflation rate for various operating and capital costs might be a lot more limited in recent times, but 1% on top of 5% on top of 20% is still a pretty big increase over the last couple of years of whatever your baseline was. You're also seeing certain areas, particularly waste and water costs, that are continuing to be quite a large and heavy requirement there. Part of that is because there's, of course, a lot of work to do. Part of it's because everyone's trying to do a lot of work at once, which means there's not enough water techs and everything else. There's not enough resource to be able to do all of the investment and all of the work when you and every other local council in New Zealand is trying to do that too. And so that pressure on the water space we expect to retain for a bit. What is a bit more encouraging, and look, I'd be happy to be told out of session this isn't happening locally, but we are hearing tidbits. It's not strong evidence yet, but you can see that transport capital costs increase has been a bit more limited in recent times. With the pullback in general construction activity across the country, particularly in residential, it's not as easy to go from residential into commercial or sort of infrastructure work, but we are hearing a few more providers and councils across the country saying that there is slightly better pricing or availability on offer in recent times. So a better ability to try and make contracts work, to get work done in the local community at not quite the same sort of ever elevating price into the future. The challenge, like I said, is that build-up in cost pressures over time means that in general you'd be hoping that you'd spend more money and get more money. At the moment you're spending more money and you'd be lucky to get the same stuff as before, and in a lot of cases you're actually getting less. To give you an idea of that, here's the cumulative increase in much more detailed capital costs that you'll be facing as a local council. These are averages from across New Zealand, but you can see the likes of building a bridge or operating a water service system or putting one in is now costing you 40% more than it was back in 2019. Same bridge, same water system, just costing you a whole bucket load more. And that increase in cost really is a challenge that is the toss-up, I think, when it comes to spending in the local community. Yes, there are key challenges around rates affordability, but there's also a pretty big expectation, I'd expect, from people that they want to be able to have clean water and for wastewater to be taken away and to have a road that sort of works. And so the struggle there is how to sort of find that balancing point in the middle. I've been ever so slightly disappointed with the government's work around the likes of rates caps for a variety of reasons. One, it's almost like rent controls, which most economists generally agree is a pretty poor idea because over time it will limit investment opportunities. It's also, it seems that what's good for local government is not good enough for central government, considering that no one has yet put a tax cap on what I have to pay in my taxes, even though central government has taken a lot more from me than my landlord has ever taken to repay the rates bill on that one. But again, your costs that you're going to incur have been material there, particularly given the different pressures around population growth, around the differences that you might have in a more provincial area in terms of the sort of area that you have to cover for both roading and water and everything else. And that's important because that actually still is your biggest part. If you look at, I've looked at this is Masterton Council spending, this is 2023 figures that I've pulled together from the official figures published by Stats NZ. You can see that the biggest amount of money that you spend combined both OPEX and CAPEX is water and transport. I'm sorry, that is not the nice to haves, that's the fairly vital stuff. You don't spend nearly all that much on most of the other bits and pieces, it becomes a whole lot more limited there. But like I say, the challenge is that the trade-offs there are going to be a lot more in the water and the transport space. There's been a lot of talk in the local government sector over the last year, particularly during the election campaign, about needing to get sort of better bang for buck and thinking about spending opportunities. I get that. Focusing though on too much of the rats and mice towards the lower end of the spectrum on this chart just isn't going to get you the returns that you might be expecting or wanting. It's much more that if you can get as good a procurement outcome as possible on the water and the transport space, that's where you can often get a lot more, I'm not going to say of savings, but potentially efficiencies when it comes to delivery and the costs. Over time we've seen that those larger and larger increases and the fact that there's been a lot of competition for work amongst councils, a lot of stuff all happening at once, which means that everyone's trying to do it, you start to increasingly get what I term the bugger off price, where everyone needs to do the work, therefore whoever's willing to pay the most goes to the front of the line and whoever is not willing to sort of goes towards the back of the line. Better coordination of infrastructure priorities across councils and with central government I think will be a key part of it, ensuring those cost pressures maybe don't go down. It's generally not as easy to bring costs down as it is to bring them up, but potentially to limit how much those increases continue to show through. So, the very last bit, where does that all leave us? You've got a whole lot of council pressures around the likes of infrastructure and similar. You've got an economy that has a bit more variety, still having elements driven by the primary sector, but also the likes of professional services and healthcare. Construction activity having pulled back on the residential front, but more infrastructure and commercial work and similar at play. long story short, this all comes back to the sort of point I made right at the start. What is the new normal? What does the economy look like in a more stable state in the future? And the honest answer is I don't think any of us quite know yet. If I did, I feel like maybe things would be a little bit easier to plan. But that's one of the challenges. The future conditions are not well set. At the moment, we do expect that with lower mortgage rates coming through and the still strong commodity prices coming from the primary sector, that you will see a bit more momentum start to show through next year, and probably most importantly, you'll have a bit less volatility that starts to emerge. We expect economic activity to start to show through more at 2% or so growth as we head through to the second half of 2026 as the economic motor winds up. But it is going to be sort of a slow slog of that recovery, and as I said earlier, it's going to be bitsy. It's not going to be all different industries moving broadly at the same pace. It's going to be some that are moving backwards still, some that are starting to advance fast, and a lot of others that are going to slowly rebuild that momentum. One of the biggest, cautions though that I want to provide going forward is that amongst all of this, there's still a lot of risk that has to be contemplated. And increasingly, the infrequent risks are now becoming a whole lot more frequent. The number of days that New Zealand is spending under a state of emergency has now become fairly consistent at over 60 days a year. If your expectations as a council are not already building in the sort of view that something big is going to hit you just about every 12 months, you're probably going to be setting yourself up for a little bit of failure there in terms of the recovery that you have to provide, in terms of the support and the resilience that you need to build into the system. Those pressures are now a whole lot more consistent than before, and so I guess the final piece there is amongst all the increasingly optimistic news that we're still feeling about the economy, there's still a lot of risks out there, and these areas are not things that you can stop emergencies coming through, but you can definitely change how you sort of respond and proactively think about reacting to them. With that, I'll turn the economic fire hose off. You can all breathe, I can all breathe for a second, but happy to take any and all of your questions on anything in the presentation or anything else I can try and help with. Thank you very much.
Brent.
A couple of questions. I'm sure I saw the figure somewhere that Masterton Rural is a very one of the wealthiest areas in New Zealand, and Masterton Urban is one of the poorest. Is that? I can't find the damn report. Is it?
So I did get this question before, and I didn't prepare anything too specific, only because I wanted to figure out, when you say wealthiest, what do you mean? You like just pure incomes, or? Sort of stuff. Okay, that's all right. Leave that with me. I won't answer that right this second, but I will come back in the break if that's all right with a bit more of an answer there. One of the challenges that we've found in recent times, and that you'll find in the future, is that local level insights below a territorial authority level have become increasingly hard to get. They're effectively only coming from the census. So we do of course have the latest stuff from 2023, but going forward, given that the government isn't going to run a census like that anymore, it might become sort of harder to get some of those figures in the future. But I'll go and have a bit of a look at those.
And two other little bits. The spending you showed for the last 2 or 3 years being flat, is that with inflation? I mean, it's a shrinkage, or is that inflation adjusted?
No, it's not inflation adjusted, so it will include the fact that you might be seeing a flat level of cash going into the economy, or money going into the economy, but stuff taken out of stores, number of items is probably going to be relatively lower because you're having to pay more for it.
Okay.
Yeah.
And last, why has roading and bridges gone up 45% in 2 or 3 years? So it can't be just road.
If I knew that, I think I would probably be a millionaire at this point. So there are a few factors. It's still not easy to say or pinpoint any one factor or sort of do the full decomposition, but what we've found when we've looked into it is a range of things. Some of it is pure labour costs. A lot of that has been labour costs, particularly for sort of more specific infrastructure roles, because there's been so much work that's been happening across the country in those areas that there's been a whole sort of shift in that space. So you've got a lot of labour costs that have come through. You've got both concrete and rebar costs that have increased quite significantly. So your structural steel had increased by quite a margin previously. You've also seen some of those higher costs for the likes of consenting, and there is some traffic elements in there. I think the thing is, when you sort of add a couple of percents onto all of your various line items, it does start to add up to a much bigger number over time. But the three parts we've seen is there's a pretty considerable level of increase that's come through from the labour piece. There's still a fair bit of materials cost around the likes of concrete, but particularly structural steel. And then there's elements of the consent, the designing, and the sort of safety elements too.
Okay, the last one we're planning on 1.4% population growth, quite a long way. What are your thoughts on that?
Population, trying to understand population trends is a tricky one. That's why I made the point earlier that it really depends on, do you take the last sort of 30 years of population growth and look at the average there? Do you look at sort of just the last 5 or sort of the 10 before the pandemic? And one of the real challenges is that given that the district's population growth is being driven so much by international but more internal migration, there are sort of two pieces that I will get to the answer of whether or not 1.4 is good, bad or otherwise. But the two sort of drivers that are a little bit more out of your hands is that international tourism is driven by whatever central government does. And that can wax and wane hugely. If you look at migration trends over the last sort of 15 years, at one point it was barely anything, sort of 20 to 30k a year. It then got up to sort of closer to 80, 90k a year. In recent times it sort of got up over 100k and then has dropped back to like 15. So at any given point, anyone could sort of, throw a dart and figure out the next migration level. So that one's just very, very hard to determine. The internal migration piece is less of a fluctuation in terms of government policy, but a lot more around that sort of triangle of jobs growth, affordability, housing affordability, and sort of lifestyle opportunities. So I think on that front, there has been more competition recently, but I still expect there to be a bit coming through. At Infometrics, we do actually do some specific population growth forecasts. I've had a little bit of a look at them. Our current medium level projection is ever so slightly below that 1.4% mark, but we sort of range, depending on a whole variety of assumptions, you could sort of see your low-high range anywhere between, I think, 0.3 and 1.8%, which is a huge amount of variety that you might have to plan for. The final point that I'd make, though, is that I think you've seen a real challenge across New Zealand in recent times, and because this question comes up quite a bit from councils, of effectively, are we overdoing the expectations around potential population growth in the future? I hear that a lot. There's quite a lot of studies out there that show that it is a lot more expensive to undercook your population expectations and underbuild than it is to overbuild. And so what we've seen over time is that there's some much larger cost to the local community and local economy if you don't provide enough for population growth, and population growth then surprises you on the upside. Yes, it might still cost you relative to getting it bang on if you overbuild, but it generally will cost you a whole lot less than if you undercook it. So I guess if I'm sitting there having to balance the risks of sort of overdoing it are not nearly as bad as the risk of underdoing it if you can get the balance right there.
Stella, thanks, Brad. Just around, you talked about the tourism, and that is an area are well below the other provincial areas around New Zealand, so my question would be, why is that? But it would be really cool to see the detail within that green line of the other regional areas to see where we sit comparatively to our friends. Yep. And then obviously we can take from that, what are they doing well, is that a possibility of getting? Yes, definitely.
And if my hotspot works quickly enough, I will give you a bit of a verbal highlight on that as well. Just because I think my intuition, I will check this, my intuition is going to be that partly that's a function of where the arbitrary territorial authority lines are. Like you look at the likes of South Wairarapa, and I expect their tourism will be a whole lot bigger, but I will check that for you right this second.
The Wi-Fi password's on the wall behind you.
Oh, is it? Should have looked at that one.
And then just one other question, because I'm certainly not an economist, I can't even say the word, economist. But you talked about, obviously, forestry being quite a large sector of employment for Masterton, yet you just spoke how shit they're doing and how, excuse my language, sorry, it's wrong, we're live, apologies, public. And that's a concern because, the costs are high and the extra. So as governors of a community, I see that as possibly a risk, because obviously if forest drops out, employment. So is that kind of, am I right in saying that should be, not that we can do anything about it as such, but from a group of people who have a bigger picture look on Masterton, that would be a concern. I'm
Yeah, in broad terms, I think that's all fairly fair, and I think probably the most important one there is that it is difficult for a council, and probably in a sense unlikely to be your biggest burning post of what you can or should do in terms of the direct implications or the direct impact you can have on forestry. But yes, there is an element there. As I say, I think one of the things that's protecting Masterton a bit more is the fact that the primary sector, although large, is not as large as other provincial economies on a relative basis, and I only say that because the minute that you get any one industry that becomes too large of a proportion, it means that you sort of live or die on that industry. And trust me, we see some of those across the country. You look at parts of the Ruapehu district when they had 2 mill closures and the potential for their ski field to go. Like the rest of the economy is not going to stick around if your major stuff all goes at once. So the fact that you've got a little bit more variety in the local economy is actually quite important because it means that you can spread your risk a bit more. But yeah, look, forestry is still under a lot of pressure. I find it interesting, just when we look through the figures, that your forestry activity is actually higher than it was a year ago, even though prices remain pretty low. And I think part of it is just sort of cash flow and turnover. You've got a lot of people that have put quite a lot of money into some of these forestry operations, and they eventually want to get some sort of return, even if it might not be nearly as good as they once imagined it to be. So there's still a challenge and a compromise there, but like I say, at the moment, prices are a lot more subdued than they would have been before, particularly relative to the costs that those operators will have to pay. So yes, a risk not as acute as in some areas, but also I think a real challenge for a council to do a lot about. Put it this way, even central government's sort of struggling over how quickly they can start to support things there.
Thank you.
In terms of the employment and GDP, just having a look, as suspected, there's quite a lot larger of a proportion coming through from the South Wairarapa. So at the moment, 3.2% of Masterton's GDP comes from tourism. The national average is 4.1%. South Wairarapa is 6%. I will do a bit more of a regional decomposition and send that through, but that gives you a bit of an idea of where that sits. I would just say I wouldn't be too concerned personally at not having an even higher tourism piece, only because, again, the worry I sometimes have because we have this question a lot, is that sometimes a focus on tourism, because it's very in your face and it's a very sort of prominent part of the economy, can distract, to a degree, not always, but to a degree, from other parts of the economy as well. In a sense, having a tourist come here for even 5 days versus a business that might move in for 365 days is sort of a very different proposition. So just sort of a fair balance point there.
No, that's good. Jamie?
You do a Wairarapa series, Brad, and the reason I asked that question is that, and we've had this forestry discussion, that the two big mills are in the Carlton district, and the forest is in the Wairarapa district generally. In the Masterton district, sorry.
Yep.
So it's a little bit difficult to compare primary sector manufacturing numbers with the health sector, and for the agriculture sector, all our product goes out of Masterton district. So all the sheep, the cattle, the dairy, the wool,
yep,
generally all leaves Masterton,
yep,
and goes to Central Hawke's Bay or Wellington. So the Wairarapa series would be quite useful to see those numbers, and it'll give a better context of
yep,
size of the economy.
So we do have that. I wanted to focus a bit more on the Masterton specifics for this one, but yes, totally, we've got those figures that are available. We're also, we work with not only the likes of Wellington NZ, but also Carterton with some of their numbers to try and provide a bit more of that context there. So I can definitely send something through. One of the, I think, challenges, as you've highlighted, is the fact that so much sort of moves around out into or out of areas. Some analysis that we've done recently, we've just done it for Gisborne district up in Tairāwhiti, is trying to understand what we sort of term the tradable sector, and so looking at sort of the entire, let's call it the value chain of it, and sort of understanding not only how much might be exported overseas, but like I say, exported out of the district, to try and understand sort of what's being influenced domestically, like on the ground local, and how much is going to be influenced by those other chains out of the area. But I'll have a bit of a look at that.
So, Brad, given the backdrop that you've given and educated guess on what might be coming, and your familiarity with local government, what would you say that, from a council perspective, and also given the changes that are being thrown at local government from central government, where do you think the priority areas possibly should be?
There's probably a couple. I mean, some of the work that's already been done in the water space, I think, sets up this local area a lot better than where it was before in terms of having to sort of think about how to grapple with those pretty big cost pressures that I was highlighting earlier. I still think that there is a real potential, particularly given some of the work that central government's just put out around regional councils and sort of more regional identities in my mind. I personally think of the Wairarapa as the Wairarapa rather than sort of constituent councils a lot of the time, just because there is a lot more sort of shared energy across the boundaries to the point around how manufacturing and the primary sector play out. And so the potential, I think, around efficiencies and sort of, shared services approaches and the likes, I think could bring big advantages, because for a lot of people, they're sort of questioning how to best get bang for buck there at a council level. There's also, I think, a big piece around costs and procurement, and I sort of mentioned that earlier in terms particularly around the likes of transport, water to a degree as well, but water and transport being the two big ones where there's potential to figure out sort of better, smarter, better procurement processes over time to not necessarily achieve savings, but more to get the sort of best outcomes time-wise and everything else, but also probably, limit some money. The biggest one, though, and I think the real challenge as you head into the next long-term plan cycle as well, is the level of engagement that needs to happen with the community over what do they want to pay for. And I sort of mean that fairly seriously, right? Like previously, and having operated in all my grand years in local government for just over a decade now, back, if you look at, I remember when I was on the Whangarei District Council Youth Advisory Group, we were looking at the upcoming long-term plan in 2015, and everyone wanted to pitch their additional ideas of this is stuff that we wanted to do, and if they were a good enough idea, it got funded, and there was a bit of an increase that came through to pay for it. This time round, anyone that wants to come with a new idea and a long-term plan round really needs to come with what they're willing to not get this time as well. And more importantly, front up to that part of the community that won't get their stuff and say, well, I think mine deserves more than you. That is the trade-off we're getting at the moment. There can no longer be sort of one in. It's got to be a one in, one out system, or probably one in, two out, depending on the cost pressures. And I think that's a real difficulty for the community. I don't think that's an easy one at all, but I do think that we've probably got to be a little bit more straight up, that in terms of the cost pressures, everyone always says, well, I don't want this, I don't want that. But then when push comes to shove, people generally some people in the community want to keep those services, and so it's balancing out not only what gets kept in the plan or what doesn't, but also who loses out while other people gain. Like, I think that distributional trade-off piece is important. Now, I actually think that's one of the most important things that local councils can do, because you are so close to your communities. And in a sense, I'm incredibly glad that I can present to you all, and I also do not envy the role that you occupy as local governors. Because one of the challenges that you find, right, is that when things go wrong, when challenges emerge, who's the first person that gets called? It's you guys. No one calls their local MP as quickly, and that's because a lot of the time when in politics, because of sort of the sort of way that central politics works, is that people get quite, not as bad as overseas, but quite tribal. If you like the current government, you think they're the best thing since sliced bread, and if you don't like them, they're the worst thing, and the sort of devil reincarnate. At a local government level, there's only two states of play. Either things are broken, in which case no one likes you guys, or things are just working, in which case I don't really care. Like, it's very unusual for local government to get plaudits and people sort of encouraged by what you do. Now, I'd like that to happen a bit more, but I think that's one of the challenges, right? If you see potholes on the street or the rubbish hasn't been taken out, then there's a challenge, and if everything's just hunky-dory, then I sort of don't think about it all that much. So that engagement with the community over what they want in and out, and sort of explaining some of those cost pressures, which is why I gave you some of those charts. I expect that most people in this room, certainly staff, will be well aware of those cost pressures, but given that households don't buy a bridge ever in their lives, those sort of pressures aren't as apparent to them in themselves.
Thank you. Wairika.
Brad, Wairika, Collings, Māori Ward Council.
Kia ora.
Just wanted to ask if you've done any number crunching in regards to the opportunities that the Māori economy might have on this stuff. Also, do you have any data that's disaggregated by ethnicity, so we can see what the potentials are with our Māori community? And lastly, post-settlement, we had our combined Wairarapa meeting last week, where we had a presentation by Ray Hall, the Chief Executive of Ngāti Kahungunu, talking about the post-settlement kind of opportunities that they're looking at, buying up land and business and all that. At what point do you take those things into consideration and their impact to the greater scheme of...
Yeah. So a few comments. One, we have done a lot more work, especially in the last 2 years, at trying to understand sort of different, how different parts of the economy work, particularly with a bit more focus on. We started off with the Māori economy, but also trying to understand what that meant a little bit more across different ethnicities to try and sort of break things down. Employment activity has been a whole lot tougher in recent times for Māori. If I look at employment growth for Māori in the Masterton district in 2024, there was a 0.2% decline. And that's consistent with what we see in labour market downturns, where generally Māori have a higher unemployment rate to start with, and so that sort of hit comes through. There has been a lot more work, I think, done in recent times around skills provision for local Māori to try and sort of bridge that gap or sort of limit things there, but we have still seen sort of pretty persistent challenges in those areas. We are doing a little bit more work in that space. Your point around the post-settlement opportunities, I think that's probably the biggest one, not necessarily directly from a council point of view, but more from a sort of local Māori economy point of view. For a period of time after original settlements started to come through, and this is more across the country, there was quite a focus by various post-settlement entities and iwi for more pure commercial returns, and you saw that in terms of buying businesses, tourism businesses, whatever else it was. And that built quite a good asset base in some areas, but doesn't necessarily return much of an outcome, if you will, to the local iwi members to the same degree. There's been a lot more focus the last couple of years by a number of post-settlement entities around the likes of housing outcomes and similar. And I think there's a big opportunity still, because we know that generally speaking Māori have lower housing outcomes, be it in terms of rental challenges or housing affordability, home ownership, but also because it then provides the ability to provide a bit more security, to have a little bit more of an increase over time in terms of construction and skills that you can sort of provide there during the construction stage, and the sort of security and the ability to interact a lot more at sort of a more culturally sensitive approach. You can have your papakainga housing and that together in a space rather than having everything scattered out as it was before. Long story short, given that there's a lot of opportunity still out there, you are in a weaker economic zone, yes, but there is still a lot of wealth available from post-settlement entities. That's probably an area where I think there's a lot more that those entities could proactively do to try and provide a little bit more development, particularly to help Māori in the local area. So a lot of opportunity. You're seeing parts there in the primary sector as well in terms of land development and similar. One of the biggest ones I think that are coming through though is sort of the export potential, where we're seeing across the world that there's still a lot of export growth that's going on for New Zealand primary products, but sort of the understanding of the provenance where stuff is coming from and the story of what's being provided is increasingly important, and the sort of fact that a lot of times, particularly in Asia, is a bit more of a kindred spirit between the approach that a number of Asian economies take to trade and sort of the Māori worldview. I think there's a big opportunity there to continue to develop more trade opportunities too.
Jamie?
There's got a couple, just a comment and then a question. So the comment is a lot of the primary sector information looking forward around exporting and consumption and protein consumption. Can't say the name, but the Olympic weight loss drug is becoming more
Ozempic or whatever.
Ozempic is becoming more and more prevalent in terms of labelling protein portions and protein sizes. So a big disruptor of primary sector protein. So that's something that's a comment. But the wellbeing indicator, or if you're allowed to use that word, or that's the closest to a lead indicator you've sort of shown us maybe. And also, do you see the ability to expand that further as a sort of, is that a proxy for Masterton's an attractive place to come to versus other provincial areas? So if you're below, it's unattractive. If you're above, it's attractive. Do you see it in that sense?
Partly. I mean, I think it gives probably a bit more of a holistic view of what the local area provides, away from just sort of the job opportunities and similar. It gives you a bit of an idea of, what's the likes of the crime rate, how active are people in the local community and a whole lot of other things. No measure is going to be perfect for that, but I think it at least gives you a bit of a starting point there. I think it depends a lot on what it was trying to be used for. In terms of, say, marketing for people to come to the area, yes, I think there's elements there, particularly, like I say, I think the biggest one would be around the likes of relative housing affordability here, plus the lifestyle element, because the lifestyle's pretty flippin' great, I must say. Having had a number of friends and similar whose parents live here or colleagues who live out this way, like that's one of the real attractive pieces. The other bit though that isn't covered as well in the wellbeing framework, but we have done some work recently, and the reason I raise that is because it's a different sort of cut of it all, is then your business attractiveness. What would bring a business into the area? What's sort of going to drive them? And there's a variety of things. Sometimes that's going to be the local market in terms of how many people they are. It's going to be hard to find an international retailer that doesn't go to a big city just because they have a hefted population. But sometimes it's around sort of skilled workers. Sometimes it's that affordability of, hey, I might be able to move my operations here, but if I can't house my people at a relatively affordable cost, that's challenging. Sometimes there are some of those elements that are actually more in council's control. What are commercial property costs and what are local rates look like? What are like commercial rates? What are water costs and levies look like? What are development contributions and similar? So there are some things that you can at least sometimes evaluate. Look, are you in the right place? Are you being really pro-development and trying to support a whole lot, but also then of course having to balance that versus someone's got to pay, so it might be the local community paying for growth. But the wellbeing front, I think a lot more on the household, the personal point of view, but there's, I think, still a business attractiveness bit there. And then to one of the points before around tourism, I think there's that third point around more the wider local identity, and I still think of that more as a wider upper identity rather than constituent TAs because of how sort of people often travel.
Tim?
Thank you. Thanks, Brad. Just a comment, I find it pretty incredible that you can talk for an hour about such a detailed topic and do it with such confidence. It's incredible. Just one comment you just said before. First of all, I find it hard to see our average income being $118,000 in Masterton, just with the community that I serve a lot. Mm-hmm. Where do those stats come from, or what would the median income be, and is there a difference between the two?
The median income will be lower. It won't be materially lower. Put it this way, I don't think I'd be able to give you the median and you go, yep, that's bang on to sort of my expectations there. I think a large part of it though is probably the diversity of different groups in terms of, if you had 2 workers in a household, then two roughly full-timers, then yeah, you'd get that income. I'm not going to say easy, but like that. But if you've got sort of a single mum, or if you've got some sort of retirees or similar, that those are all going to sort of fluctuate through the middle. So it probably depends a little bit in terms of what group you want to look at. And I must say, if I can do this on the fly, I will. Just because we have, in our tools, we've now integrated all of the census data that's come out to give us a bit more of a view on what's happening or sort of what the composition of different households is. It's not perfect, it doesn't sort of break it down as nicely as we'd want it to sort of say, well, there's one person who works full-time, another that works 20 hours a week, and a 3-year-old kid, but it does give us a little bit more information about sort of what those households look like. If I find it. So, for example, and this is part of the difficulty, in Masterton, about 36% of the families and households in the district are couples with children, compared to about 42% for the national average and 42% for the Wellington average. So there's a slightly lower proportion of that couples piece. Part of that then is going to come through with the likes of, there'll be a few more superannuitants and similar would be my expectation in terms of retiree people. But I can provide a bit more of a breakdown in terms of what the different cohorts look like as well, if that's useful.
Yeah, that would be really useful. I mean, I just think of the higher setting teacher at the top of the scale would earn $100,000. And I know a lot of people who are in that situation who are on their own.
Yep.
And that's a lot below 118 grand.
Well, I think just one point briefly on that though is that you'll also have the likes of, this is sort of total income, so it includes investment returns and similar, any other support that might be coming through from government. So for example, that one teacher, for example, might also be getting, say, working for families tax credits and similar, which would then sort of lift their overall sort of ability to spend. So that's not to say that the numbers right, wrong, or otherwise, it's just there's quite a lot of nuance, and that's one of the, I guess, most interesting things we've found. So we model this data because there is no household income data outside of a regional level in New Zealand. It just doesn't exist outside of census. And the challenge with census is that people only record what their pay stub looks like, not all their other income. So we have found quite a discrepancy or quite a difference between stated income and sort of realised income at the end of the day. But that's just sort of a context point there.
Yeah, that's a great point, because the person I've got on my mind has got 3 children, so that would be working for families on top of that, wouldn't they? And just one more point, you said about, when, I think you implied when things are working kind of well in council, people don't care.
I'm being a little bit mean to you there, but...
But I would be saying people don't worry.
Yes.
They don't care. And when they don't worry, it means that you are able to focus on other things more efficiently.
Yep.
And so I think when things do work efficiently at a council level, you think, okay, that's parked, don't have to worry about that. But if you've got a sewage overflow on your property, it's consuming everything you do, and it means you can't do other things as well as you could do. So just a comment.
Yeah, no, and you're totally right. I think that was more born out of the fact that I think you see real... Like I say, the comparison was more around how strong of a view people have, positive or negative, about central government relative to like you say, the sort of the most positive the council can be is not change, sort of not being noticed, like you say, in people's lives. So the no worries comment is 100%. I'm on board with that. Yeah.
Are there any other questions? And I agree with Tim. I don't know how you can speak that long without drawing a breath. It's a skill.
It's an acquired skill, that's for sure.
An economist.
No, that was fascinating. Very good. Thank you very much. Terrific backdrop for our discussions this afternoon. And we appreciate you coming over and joining us. Thank you very much.
Thank you very much.